following a important endeavor here, which has been in place a long time, but at this time I will open the meeting, call the meeting to order. I'd also like to note that Matthew Harness is the observer for the Speaker of the Assembly. Doreen and Sarah is the observer for the Senate Majority Leader, and Mark Wurzel is the observer for the City Council Minority Leader. They're all observing today. So I'll first entertain a motion to approve the minutes of the last annual board meeting, which was held on August 3rd, 2021. All right, thank you. Now we'll begin a review of the city's financial plan. The next item is the financial plan for fiscal year 2023 to 2026. Mr. Mayor, I understand you'll present the city's four-year financial plan.
Thank you. Thank you, Governor, and good morning as well. And I want to acknowledge the presence and thank my good friend, State Controller Tom DiNapoli, Controller Brad Lannis, City Controller, and the private members, Secretary of State Rosanna Rosado, Stephen Cohen, and my longtime friend William Thompson. I want to thank you all. I want to thank the City Council for their partnership and the members of my team who are here with me today, both First Deputy Mayor Lorraine Grillo and Budget Director Jacques Jihad. The adopted plan follows the guideposts I set down in January. This includes promoting the city's economic recovery, building and maintaining budget reserves, achieving budget savings, using resources efficiently, and lifting New Yorkers and working families. The bottom line is that we are boosting the recovery and increasing resiliencies like never before. If we were to start with last year, fiscal year 2022 ended with a $6.1 billion surplus that we used to prepay current year expenses. As in the past, we used the gap closing strategy to balance the $101.1 billion fiscal year 2023 adopted budget. Our out-year gaps are manageable, falling below the 20-year average as a percentage of city funds spending. Cautiously estimating revenue is the cornerstone of our fiscal management strategy and protects the recovery by ensuring that we responsibly meet needs as they arise. At adoption, we adjusted our fiscal year 2023 revenue forecast upwards to reflect a $1.5 billion in additional tax revenue. This growth was driven by the impact of record level of Wall Street activity in 2021 on personal income taxes. We used these additional revenues to prepay expenses and reduce the current fiscal year budget year gap. They also were the key to strengthening our reserves. Our planning must recognize that we face uncertainty, and I just really want to emphasize that we face uncertainty in the future. I agree with my friends here today that building and maintaining budget reserves as a buffer against the unexpected is a critical priority. So, at adoption, we partnered with the City Council to increase reserves by $2 billion, which is the largest single contribution to reserves in the city's history. There is now $1.9 billion in the Rainy Day Fund, $4.5 billion in the Retiree Health Benefits Trust, and $1.6 billion in the General Reserve, as well as $250 million in the Capital Stabilization Reserve. The $8.3 billion we have set aside in reserve is a record level and exceeds 10% of city's funds revenue for the first time, which is a benchmark recognized by rating agencies and fiscal monitors. On top of building and maintaining reserves, we have remained committed to reducing headcount and achieving savings. Through our strict headcount and attrition management, we have reduced employee headcount to just under 304,000. This is 23,000 lower than the city's peak in September 2019. As I have made clear, I will keep pushing city government to be more efficient and use taxpayers' dollars wisely. In this budget cycle, we set aside additional resources to defray the cost of upcoming labor negotiations. By adding nearly $4.7 billion to the labor reserve across the financial plan, we have now funded 1.25% annual wage increase for city employees. Now, we're clear that this is a beginning, not an ending. However, while we are committed to paying fair wages, we will not make deals that the city cannot afford. Further, as financial conditions have changed dramatically since the height of the pandemic, we have removed unallocated labor savings from the financial plan out years. While this grows out years gaps, it more truly reflects the current financial condition that we are facing. On top of strong fiscal management, to fully recover, we must make the city safer and cleaner and help members of our community who were disproportionately impacted by the pandemic. We're trying to bring New Yorkers back to this important level. We don't want to go back to the way it was. We want to take it to the place where it should be, a place where everyone across the 5 boroughs has opportunity and would thrive and prosper. To get this done, we made commitments to subway safety, expanded summer jobs, and enrichment opportunities for youth, and are connecting even more at-risk New Yorkers with green jobs. Recognizing the importance of our human and legal services providers, we were on the front lines during the pandemic. They were on the front line during the pandemic. We baselined a contract adjustment. To help working families, we worked with the governor, and I want to thank you, Governor, and the state lawmakers to expand the New York City earned income tax revenue and credit, and provided incentives for employers and property owners to create more child care options citywide. And because vital public spaces are so important to the recovery, we made significant investments to keep our streets and parks cleaner, safer, and more inviting. These investments were made possible by our commitment to achieving budget savings and the prudent use of additional revenues. To conclude, I'm proud to say that the city has met all requirements imposed by the Financial Emergency Act, and that our financial plan advances the recovery, is fiscally responsible, and builds a stronger and more resilient New York. Rating agencies support our approach. In May, Fitch Ratings singled out our commitment to building and maintaining record levels of reserves and upgraded the city's ratings from stable to positive for the first time in more than a decade. And our economy continues to strengthen, creating jobs at a quick pace. We have now recovered more than 80% of jobs lost in the height of the pandemic and expect a full recovery within 2 years. So I want to thank you for this opportunity to speak with you today and for the important work for the city and the people of this city in the future. Thank you very much. Thank you, Governor.
Thank you, Mayor. And at this time, I'd like to ask if Comptroller DiNapoli has any comments on the city's financial plan?
Yes, thank you, Governor Hochul, very much. And thank you, Mayor Adams, for your first report to our board, to you and your team working with the City Council. Thank you for all of your great efforts. I'd also like to acknowledge City Controller Brad Lander and his team and the public members, former Controller Bill Thompson, a good friend to all of us, Rosanna Rosato, and Steve Cohen for his efforts as well. I'll offer some brief observations. We've distributed our review of the financial plan. It was prepared by the State Controller's Office for New York City, which is headed by Rahul Jain, who's at my right. The last 2 fiscal years have offered a look at the resilience of the city's people, its economy, and its budget. They have also affirmed the critical role federal relief efforts and the work of our congressional delegation have played in getting New York back on its feet. In fiscal year 2022, New York City was able to continue to build on a trend that began in fiscal year 2021, as direct federal relief and aid offset planned revenue loss and flowed through households and businesses to boost the city's business and personal income tax revenues. We estimate the city will receive over $27 billion in direct pandemic aid over the 7-year period starting in fiscal year 2020 to counter the public health risk and provide funds needed to advance economic recovery. City tax revenues also exceeded expectations by $7 billion in fiscal year 2022, boosted by Wall Street and other office sectors, including a growing technology sector, as well as the return of tourism. On the spending side, the city leveraged federal funds to support recovery programs and generated substantial cost savings. Much of these savings came from a sustained, lower-than-proposed headcount, a trend our office identified mid-year. To its credit, the city has used these positive developments to take budget management steps that recognize the uncertainty it faces over the next few years. The first of these was to make and then increase the level of deposits into the city's rainy day reserve. While the fund sits at about just under 2% of spending, it has grown steadily since its recent creation and represents a true set-aside for managing short-term fiscal stress. The city also added budgetary flexibility by increasing its contingency line item, the general reserve, and setting aside additional money for OPEB benefits. These steps were necessary, but more can and should be done. A shifting economic and fiscal landscape threaten the same factors that have enabled budget surpluses over the last 2 fiscal years. Profitability on Wall Street and in other sectors is slowing, and bonuses are likely to follow, putting pressure on business and personal income taxes. The city's own forecast suggests revenue will decline in fiscal year 2023, led by personal income tax revenue, which the state also recently revised downward. The city's estimate, while reasonable, does not take into account the possibility of a recession. Federal relief aid is also winding down, and the city has taken some of these funds and created programs that are likely to recur, which will need to be funded by the city's own revenues once federal aid is exhausted. The cost savings achieved from lower than expected headcount, while significant, may be diminished going forward as the city fills its vacancies and adds new positions for new programming. Financial markets have turned from the extraordinary growth seen in 2021, which allowed the city to lower its expected pension contributions. Pension fund performance in fiscal year 2022 will now weigh on the city's out-year budgets. In all, we believe the city is now facing risks exceeding $5.9 billion in 2026, after federal money is fully exhausted and the effect of this year's pension results are taken into account. This is on top of the $4 billion gap the city has identified in that year, bringing the potential 2026 gap to $9.9 billion. These are the risks that are straightforward to quantify. The city also faces risks that are more difficult to quantify with certainty, but they too could be substantial. First is a possible recession. During the last 2 recessions, which were severe, the city saw revenue drop by 4.2% and 5.9% from projections, equivalent to between $3.1 and $4.4 billion in revenues applied to current projections. This does not include the potential spending implications of more individuals and households needing city supports and services. Even now, the city's unemployment rate stubbornly remains above 6%, with certain demographic groups bearing the brunt of that burden, an issue that we've also raised earlier this year. The city cannot afford significant setbacks to the recovery of businesses and jobs. Our risk assessment also does not include the potential cost of collective bargaining. In fiscal year 2022, the city recognized its projections for labor were unrealistic, and over the year restored unspecified productivity savings and built in 1.25% salary and wage increases. Even with these prudent adjustments, my office has noted that setting wage increases at the city's projected level of inflation would cost an additional $3.6 billion by 2026 if the city cannot agree with its labor partners on other means for offsetting those increases. We encourage the city and its labor partners to find common ground to keep the city on sound financial footing while providing its workers with wages that recognize their role in keeping the city running during these difficult times. This will bolster worker retention, an issue that's facing government across the country, not just here in New York City. The city has also created substantial new programming that are unfunded in later years in its financial plan. New popular programming will likely create spending pressures that will need to be managed, particularly if revenue growth is slower than expected. These many challenges and uncertainties place a premium on having funds set aside to bridge a period of fiscal weakness. With over $8 billion in reserves and other funds in its health trust, the city has made progress in buffering against uncertainty and being able to maintain the programs necessary to foster an economy that is still recovering. But reserves must be used for their intended purposes and keep pace with spending growth, particularly given potential budget risks. As gaps are closed, better than projected results may allow the city to set aside additional funds for reserves, as it did in fiscal year 2022. It should take every opportunity to build its rainy day fund up to levels that are closer to national peers. In addition to the practical matter of making sure revenues and expenditures are in balance and setting aside surpluses, there's another concern I believe it's appropriate to raise. Each year in preparation for this meeting, my office reviews the city's access to the capital markets, the underlying reason for the Control Board's creation. A critical reason for the city's maintaining high marks for its credit worthiness over the past 2 years is the recognition of the city's strong fiscal governance. The discipline enshrined in the law that created this board is viewed as a critical contributor to the city's credit profile. In recent months, questions over the budgetary process, the rationale behind the set-aside of surplus, and the use of federal money have highlighted the often understated importance of fiscal planning, consistency, and transparency. These tenets of good fiscal governance were fundamental components of the Financial Emergency Act during another period of uncertainty for the city many years ago, which set it off on a path of renewed economic and fiscal strength. The city should think long and hard about those lessons now and show the will to further systematize its reserve policy and other procedures that will enhance transparency in the management of its finances to provide additional confidence to credit markets. The credit profiles of the state and other related entities, such as the MTA, are reliant on New York City's economic and fiscal strength and will also benefit from such actions. In sum, we are in a very different place from 2 years ago at this time. Leveraging the city's relatively strong fiscal position as long as it continues and strengthening policies to enforce fiscal discipline will help the city be prepared for future fiscal uncertainty. These steps will also provide it with resources needed to continue to execute on its plan to ensure a recovery for all. Again, I'd like to thank all of my fellow board members, the staff at the Control Board for their cooperation, City Controller's Office, Office of Management and Budget, and the State Division for Budget for your work during these difficult times. We look forward to continuing to partner with you as we move forward. And I was reflecting that I think this is my 16th board meeting. So do I get a longevity bonus for that? I'm not sure. Double in the salary. Double in the salary. Thank you very much. Thank you, Governor.
Thank you, Comptroller DiNapoli. At this time, Comptroller Lander, would you like to comment on the financial plan?
Thank you so much, Governor. Like you and the Mayor, I'm honored to be here for the first time at the Financial Control Board with our veteran Comptroller DiNapoli. It was great to be out with all of you yesterday on Eastern Parkway for the West Indian Day Parade. This is almost as much fun commenting on the city's financial plan. And thank you also to our private members, Rosanna Rosado, Stephen Cohen, and I want to say a special thanks to former New York City Controller Bill Thompson, who's been a great mentor and friend to me. As I've come into the office, like Controller DiNapoli, we've published our adoption report. Our Executive Deputy Controller, Francesco Verdizzi, and our Deputy Controller for Budget, Krista Olson, are with me today, and you can get that report in full if you think that's even more fun than marching in Carnival. As we meet today, as summer turns to fall, and as we move into what will, we pray, be a durable emergence from the pandemic, and with this good new political leadership in place, we've got both an opportunity and a responsibility to rise to this complex and indeed, Mayor, uncertain economic moment with far-sighted action that helps to secure a vibrant, inclusive, and resilient economic future for New York City. As we're all aware, we're facing a period of significant economic uncertainty and mixed signals. Fiscal year 2022 was a year of robust economic recovery for New York City. Private sector payrolls increased by 300,000, and they were back to 96% of pre-pandemic levels. The unemployment rate dropped by 4.6 percentage points. Tourism made a strong comeback. We saw a record number of new business applications, very encouraging. City tax revenues reached a new peak. It is a testament to the strength of federal fiscal and monetary policy interventions and to the city's economic resiliency that tax revenues continued to grow through the pandemic. But as has been rightly noted by each of the previous speakers, the recovery remains incomplete, precarious, and uneven. High inflation is biting sharply into families' purchasing power to afford housing, food, healthcare, childcare, and transportation. The city is still 160,000 jobs short of the pre-pandemic peak, and commercial real estate faces a challenging adjustment to new work practices. Even if the Federal Reserve successfully lowers inflation without causing a recession, higher interest rates will slow economic growth, causing real pain for New Yorkers and reducing revenues for the city. And we must reckon with the fact that both the pains of inflation and of job losses are borne disproportionately by low-income New Yorkers. The unemployment rate among Black New Yorkers remains above 10%, 3 times the national average. Last June 2021, the then mayor forecast FY22 tax revenues at $62.4 billion. In June 2022, the forecast under the current mayor rose to $68.6 billion, 10% higher than originally projected. And based on June tax collections, the final amount will be closer to $69.5 billion, a real opportunity for additional deposits into our long-term reserves. But no one around this table believes those trends will continue. Looking ahead, like others, we believe economic growth will moderate and tax revenues will drop next year, broadly in line with OMB's and the mayor's expectations. Only in FY 2025 and 2026 does our tax forecast rise moderately above City Hall, and even with that slightly or rosier outlook in the out years, we do not expect tax revenues to cover additional expenses which are not yet reflected in the financial plan. Systemically under budget expenses of overtime, Carter cases, homeless shelters, and others remain areas of concern. As has been noted, the labor reserve cannot yet keep pace with inflation, and the expiration of stimulus funds creates fiscal cliffs in FY 25 and 26, particularly for important recurring programs funded through these one-time dollars like the 3K expansion. As the state controller noted, starting in FY 24, the budget will reflect the impact of adverse financial market conditions on pension fund returns. After an extraordinary year last year, in the first half of this year, equities had the worst performance in 50 years, and all major asset classes except commodities incurred significant losses. As a consequence, the combined return of the city's 5 pension funds was negative 8.65%. The pension funds remain well funded, and the retirement security for the city's current and future retirees is extremely solid. Still, after last year's strong returns, generating $8.8 billion that will not be needed by city funds, we estimate this year that we will need to make higher pension contributions, the city totaling nearly $6 billion from FY24 to FY26. We'll be looking in our office at our asset allocation in the coming months and do the best we can for the strongest possible returns in the months and years ahead. Overall, very much in line with what Comptroller DiNapoli said, we estimate budget gaps of $869 million in FY23, $6.4 billion in FY24, $7 billion in FY25, and $9.5 billion in FY26. These are sizable gaps and will require strong fiscal discipline in order to avoid harmful cuts to services. Ensuring the city can meet our obligations to our creditors, our workforce, our vendors, and to the services expected and needed by our residents is the essential work of this board and of all of the folks around it. I do want to give some credit where it's due. The city set aside $2.2 billion in long-term reserves in the Revenue Stabilization Fund and the Retiree Health Benefit Fund in FY22 to weather the possibility of an economic downturn. While this deposit was slightly lower than the $2.5 billion that my office recommended, it was a strong step forward toward fiscal stability, and the mayor and the city council deserve real credit for it. The total of our long-term reserves, as we count them, we don't include the general reserve in our long-term reserves calculation, sits at 9.4% of tax revenues. As high as it's been in years, but still below the 16% that we estimate is needed to weather the full length of a recession. For this reason, and given those strong FY22 year-end excess revenues I mentioned, we believe an additional $800 million should be deposited into the Revenue Stabilization Fund at this time. And we continue to recommend, as we've heard frequently from our friends at the Citizens Budget Commission and share this point of view, that the city should adopt a formal and explicit policy backed by a quantitative assessment of economic risks and revenue volatility to set a goal for the size of long-term reserves and for both deposits into and withdrawals from that fund. Over the years, many of the provisions of the Financial Emergency Act have been incorporated into the city charter, with one important notable exception of the General Debt Service Reserve, whereby the state controller retains property tax revenue for general obligation bonds debt service before it comes into the city's general fund. We think that is a strong practice, and we support, and I know that OMB supports this as well, state legislation to make the General Debt Service Fund a permanent feature of the city's financial and budgetary system. We think that would be another strong step forward. Let's see, I'm going to skip a couple of things that have been said a few times before I don't need to say them again. I will say in the coming months, we have the best opportunity in many years to reform New York City's broken property tax system to address both the unequal burden on outer borough and working class homeowners and the excessive burden on multifamily rentals. Working together with a coalition of city and state elected officials, we're building public support for much needed reforms. And with the help of everyone around this table, I believe this could be the year to finally pass changes in Albany and implement a strong new long-term property tax system for New York City. Many critical questions remain that we're all facing on a daily basis. What's the impact of hybrid work on our economy and for our commercial tax revenues? How do we live up to the commitment that we made to address inequalities in the labor force that we saw during the pandemic, even as we face all these challenges? How can New York City confront the ongoing crisis of housing affordability, making it increasingly difficult for families to buy a home or build wealth in our city, and driving homelessness up? How will demographic and migration patterns affect the city's economy and the services we need to provide? We're already seeing those challenges both in our public schools, while I support using the remaining federal stimulus funds to cover cuts to individual school budgets. In the long run, we need to make a plan for our public school system that balances city and state resources, student needs, and educational goals. The foundation aid, Governor, that you and the legislature provided have been an enormous help and will be critical in the long term. And the same questions will face our public transit system as well. Farebox revenues are down. Ongoing investments are needed. The support of the governor and the mayor for congestion pricing, a great step forward, but we are going to face real long-term challenges in our public transit financing. Those are all large and daunting questions, but while the economic certainty of this moment are real, it is beyond doubt that the city is in a far stronger governance position than during the crisis that drove the creation of this board in the 1970s. I want to credit Governor Hochul and Mayor Adams for establishing a joint task force on some of these questions in the city's Midtown and Central Business District economic future, a real sign of collaboration that is too rare, but between governors and mayors, but critical for our thriving. And I also want to thank the mayor for his collaboration with our office and with Deputy Mayor Grillo on critical questions of procurement, infrastructure, and capital projects management. The challenge of our moment is to build thoughtfully on our city's strengths, to remain diligent in our fiscal responsibilities, and to guide our city toward a more just, inclusive, and financially sustainable future for all New Yorkers. Thank you for the opportunity to comment on the city's adopted budget and financial plan and on our shared economic future.
Thank you, Comptroller Lander. At this time, I would like to call on Michelle McManus, the Deputy Director of Finance and Capital, to present the staff's comments.
Thank you, Governor. While the national economy has recovered substantially from the depth of the pandemic, economic growth is slowing in 2022. Growth in real gross domestic product slowed to an annualized negative 0.6% in the second quarter of 22 after dropping 1.6% in the first quarter. The economy faces several headwinds, mainly inflation. To combat inflation, the Federal Reserve embarked on an aggressive monetary tightening policy, increasing the target federal fund rate by a total 2.2 percentage points since March, with further increases expected by the end of 2020. Similarly, the city's economic growth is poised for a slowdown in 2022. Economic indicators in the city are mixed. The local unemployment rate is falling, tourism continues to improve, and building permits are rising. However, the metro area inflation rate is at a record level, the Manhattan office vacancy rate is the highest on record, and Wall Street profits are declining. Since the June 2021 financial plan, city-funded revenues in fiscal year 22 are higher than projected by more than $7 billion, fueled by a record level of Wall Street activity in 2021, allowing the city to generate surplus funds of $6.1 billion in fiscal year 22. Securities industry profits totaled $58 billion in 2021, the second highest year on record. This level of activity in the securities sector propelled personal income and general corporation tax collections upward. However, Wall Street profitability has begun to wane substantially in 2022, contributing to an estimated drop of more than $2.3 billion in combined personal income and business tax revenues in fiscal year 23. In the first half of 2022, recorded Wall Street profits were lower by 56% compared to the same time last year. Facing an environment of tightening monetary policy, real estate transaction taxes are projected to drop in 2023. While they are forecasted to rebound in fiscal year 24, they are not expected to recover to the fiscal 22 levels by the end of the plan period. Commercial rent tax revenues are expected to remain relatively flat over the plan period, reflecting the commercial rental market. Although the average office occupancy in the city has improved, demand in office space market remains low and vacancy rates stay high. Overall, city-funded revenues are projected to drop by $1 billion to $73 billion in fiscal year 23, before rebounding to almost $77 billion in fiscal year 26. Total funded revenues in the current plan are projected to decline by more than $10 billion from fiscal year 22 to 23, driven by an almost $10 billion drop in federal categorical grants due to the winding down of federal COVID-19 relief funds. In fiscal years 23 to 26, total funded revenues are projected to grow from $101 billion to nearly $103 billion due to growth in tax revenues. The June 2022 financial plan assumes total funded expenditures of almost $112 billion in fiscal year 22, up by $2.6 billion from the executive budget, partially due to contributions of $750 million to each of the Rainy Day Fund and Retiree Health Benefits Trust. We urge the city to continue to maintain a budget practice of making annual contributions to the RHBT. The city is using the $6.1 billion of surplus funds built up in fiscal year 22 to prepay fiscal year 23 debt service and retiree health care expenses. In fiscal years 24 to 26, projected total funded expenditures are $105 billion, $106 billion, and $107 billion, with budget gaps of $4.2 billion, $3.7 billion, and $4 billion, respectively. Based on our risk analysis, the budget gaps could be higher at $5.4 billion, $6.6 billion, and $7.2 billion, driven mainly by higher pension contributions. As a result of declining market conditions, we estimate an aggregate negative return of 9%, equating to a shortfall of 16% against the actuarial interest rate assumption of 7%. For fiscal year 22, we estimate a loss of $36 billion, which we project could increase pension contributions by $809 million in fiscal year 24, $2 billion in fiscal year 25, and $3.1 billion in fiscal year 26. Prudently, the city has added $3 billion over fiscal years 22 to 26 to the labor reserve to fund assumed wage increases in the next round of collective bargaining. The city had previously assumed 0.5% increases in each of the first 2 years in the first round of collective bargaining, and 1% annually thereafter. The plan now assumes wage increases of 1.25% annually. The city has also increased the general reserve by $500 million to $1.6 billion in fiscal year '23, and $200 million in each of fiscal years '24 to '26 to $1.2 billion. The city has also provided a one-time property tax rebate to city homeowners totaling $90 million in fiscal year '22. Nevertheless, the city has yet to allocate funding to pay for recurring programs and initiatives financed with federal pandemic aid beyond fiscal year '25. Additionally, we urge the city to continue to generate programs to eliminate the gap with recurring savings similar to the program released in the February modification. The city's current 5-year capital plan for fiscal years '22 to '26 amounts to $95 billion in total funded authorized commitments, representing a $5 billion decrease from the level of commitments projected in the February modification. The city projects 81% of the capital program to be funded with tax-supported debt. Based on current tax revenue projections and assumptions of the local economy, the assumed debt service expense as a percent of tax revenues is projected to remain below the affordability threshold of 15% throughout the 5 years. Even though commitments in the 5-year capital plan have been reduced, we are doubtful the current amount of commitments will be attainable based on the city's past achievement levels. Consequently, we urge the city to undertake a review of its capital program and give more consideration to prioritizing a plan that can be practically undertaken and managed. Thank you.
Thank you, Deputy Director. At this time, I'd like to offer an opportunity for any private members to have comments on what you just heard.
Thank you, Governor. I'm going to be very brief, and normally I don't have a comment at this point, but 2 points I'd like to make. Number one, let me thank you for being here this morning and chairing this meeting. And secondly, let me congratulate the mayor and his team. This is in just an excellent fiscal job, and really love the building of reserves and the smart planning for the future, Mr. Mayor. It's an excellent job, and it is something that others have talked about in the past, played at the edges, but you've done it. So let me congratulate you and your team for a job well done. And it is great to see that the city is moving forward strongly and in able hands. So congratulations, Mr. Mayor.
Any other comments from private members? Mayor Adams, would you like to respond to these comments? You just got a nice compliment. Maybe just-
We have, and I thank you, Controller, a person who has been here watching these challenging economic times. And the uncertainties are real. And I think what is paramount, sometimes New Yorkers don't realize when they have navigated difficult waters. This governor has had to deal with everything from the pandemic to monkeypox to polio, to crime, the economic uncertainties. And in spite of that, the uniqueness of having a relationship where a governor and a mayor like each other. And we're willing to work with each other, because that's the only way we're going to get through this, for New Yorkers in the city and the state to be united. And the controller touched on it. We have to be clear. We are entering uncertain waters. And if we're not together, then New Yorkers are going to be impacted. And we are going to be forthright, honest, transparent. We're going to let New Yorkers know what we are facing and some of the difficult moments that we have. But we are going to get through this. We are resilient. We're New Yorkers. 2001, we focused on 9/11. I focused on 9/12. We got up. And when New Yorkers got up, the country got up. And we're here again. And I'm confident that we're going to get up again. Thank you.
Thank you, Mayor. At this point, I'll call on Michelle McManus to report on the staff's findings regarding fiscal year 2022 and your recommendations concerning the proposed resolution.
Thank you, Governor. The Financial Emergency Act contains 5 conditions that we review to determine whether or not the city is experiencing fiscal stress. I'd like to go over them now for the board. 1, The city shall have incurred a deficit in excess of $100 million in the result of operations. The city has ended fiscal year 2022, subject to the final audit, with a surplus of $6.1 billion and has prepaid fiscal year 23 expenses. 2, the city shall have failed to pay principal or interest on any of its notes or bonds when due and payable. 3, the city shall have issued notes in violation of restrictions on short-term borrowing set forth in Section B of the Act. 4, the controllers shall have jointly certified that they cannot, on the basis of facts existing at the time of such certification, make the joint certification required to terminate a control period. The city has paid all principal and interest on its notes and bonds and has not violated any of the short-term borrowing provisions of the FEA. I have also received letters from the state and city controllers informing me that they do not see any likelihood that they would have reason to issue a joint certification relating to market access. 5, the city shall have violated any provision of the Act, and such violation substantially impairs the ability of the city to pay principal or interest on its notes or bonds when due or payable, or the city's ability to adopt and adhere to a balanced operating budget. The city has not violated any provisions of the Act. The staff therefore recommends that the board approve a resolution determining that of September 6, 2022, none of the events which would have required the imposition of a control period has occurred, nor is there a substantial likelihood and imminence of such occurrence, and that the city is not experiencing fiscal stress at this time that would jeopardize the orderly functioning of the city's fiscal affairs. Thank you.
Thank you, Deputy Director. Any comments? At this time, I'll entertain a motion to approve the determination.
So moved.
Is there a second? Second. At this point, I'll entertain a motion to adjourn the meeting.
So moved.
All right, second. Meeting's adjourned. All right.